For the last decade, Wall Street evaluated Amazon through a specific lens, a massive e-commerce marketplace subsidized by a highly profitable cloud computing division. The consensus assumes the retail side operates on razor-thin margins to capture market share, while AWS generates the actual cash flow. But that dual-engine model ignores a third business segment that is currently outstripping the growth rate of both the retail marketplace and the cloud. That segment is a digital advertising operation, currently generating over $70 billion in trailing 12-month revenue. To understand that scale, look at this revenue comparison. In 2018, AWS generated $25.6 billion for the entire year. Today, Amazon's trailing 12-month ad revenue dwarfs that figure by a factor of nearly 3. This advertising division represents the fastest-growing part of Amazon's modern portfolio, and it operates with economics that closely mirror high-margin enterprise software. Accurately valuing the company today requires modeling it as a closed-loop advertising empire, protected by an impenetrable data moat. The foundation of this advertising engine sits at the very bottom of the marketing funnel, search advertising. When a shopper searches for a product on the marketplace, brands bid on sponsored products listings. They pay Amazon to guarantee their items appear at the top of the search results, capturing the user exactly at the point of purchase. This funnel diagram illustrates how Amazon captures demand beyond its own website. In the middle tier, the demand-side platform, or DSP, tracks a user as they leave the marketplace to read an external blog, triggering a targeted ad on that third-party site. The DSP allows Amazon to monetize its proprietary shopper data across the broader internet, selling highly targeted inventory on partner websites and connected TV apps. This capability has scaled to the point where DSP utilization now accounts for nearly a third of all ad spend within the Amazon ecosystem. At the top of the funnel, Amazon drives broad brand awareness through its streaming properties, locking down premium live sports and entertainment inventory. The ad-supported tier of Prime Video alone reaches an audience of 115 million monthly viewers. By architecting this three-tiered system, Amazon captures marketing budgets at every stage of the consumer journey, from passive video streaming to active product purchasing. Across the broader digital advertising industry, macro-level privacy updates and the deprecation of third-party cookies have severely degraded targeting capabilities. Historically, the incumbents relied on proxy data. Google models intent based on what users search for, and Meta models preferences based on user identity and social graphs. Amazon does not need to guess intent. It utilizes deterministic, first-party purchase data, a direct log of what consumers actually buy, when they buy it, and how often. Because this data is generated entirely within Amazon's own closed-loop ecosystem, it remains completely unaffected by the privacy restrictions engineered by Apple or Google. To further lock in brands, Amazon made its data cleanroom, the Amazon Marketing Cloud, free to use for advertisers starting in September 2025. The result of this structural advantage is near total dominance in domestic retail media. Look at this breakdown of U.S. retail media ad spend. Amazon controls nearly 80% of the market, leaving its closest competitor, Walmart Connect, with a distant single-digit sliver. Global privacy restrictions designed to limit data tracking have inadvertently fortified Amazon's position, cementing its marketplace as an unassailable data monopoly. Amazon is now leveraging its position to transition from simply selling ad space to fully automating the creative workflow for the brands buying that space. In the first quarter of 2026, the company launched Creative Agent, an AI tool built to generate assets for full-funnel advertising campaigns. This schematic illustrates the tool's back-end architecture. Foundation models like Amazon Nova and Anthropic's Claude run on AWS Bedrock, processing brand data to output complete, multi-scene video and display ads. By eliminating the steep production costs and lead times traditionally required for video assets, this tool specifically targets and lock in mid-market advertisers who previously lacked the budget for premium placements. On the consumer front, Amazon integrates sponsored prompts directly into its AI shopping assistant, Rufus. According to Q1 2026 earnings data, nearly 20% of shoppers who interact with a brand prompt in Rufus continue the conversation about that specific brand. Deploying artificial intelligence to build the ads on the back end and to serve them via interactive chat on the front end creates a highly efficient conversion cycle that keeps ad budgets firmly within Amazon's ecosystem. To see the financial impact of these systems, we can track the segment's recent revenue growth. In fiscal year 2024, Amazon ads generated $56.2 billion. The following year, that figure jumped to $68.6 billion, representing a 22% growth rate. In the first quarter of 2026, growth accelerated further, rising 24% year-over-year to $17.24 billion for the quarter. Amazon does not officially break out the profit margins for this division, but Wall Street consensus estimates are clear. Analysts project operating margins for the ad segment sit between 40 and 50%. Current projections for fiscal year 2026 estimate total ad revenue will land between $82 and $91 billion. Applying 50% margins to $90 billion in revenue means the advertising division operates with the economics of a premier software business, entirely reshaping Amazon's actual profitability profile. The primary threat to this high-margin growth engine comes from severe regulatory scrutiny, specifically domestic pressure from the Federal Trade Commission. The FTC is running an active probe into Amazon's search ads, investigating whether the company failed to disclose reserve pricing or hidden price floors to its advertisers. If the FTC proves deceptive pricing practices occurred, the resulting penalties could number in the billions of dollars. This domestic pressure is compounding with international regulatory pushback, including a specific lawsuit in Australia regarding the rollout of the Prime Video ad tier. These legal headwinds join standard macroeconomic risks, as brand advertising budgets are inherently cyclical and vulnerable to economic downturns. However, these risks must be weighed against Amazon's deeply entrenched structural advantages. The company holds a distinct triad of dominance: unrivaled first-party purchase data, high-margin software economics, and deep AI workflow lock-in. While this is not financial advice, the data presents a clear picture. Investors who fail to model this $70 billion advertising engine are mispricing Amazon's future cash flows.